Hello and welcome to Investomedia. Dividends are a sign of financial strength and stability, as companies that are profitable and generating cash flow are more likely to pay dividends to their shareholders. Companies that have a long history of paying dividends are often viewed as reliable and trustworthy investments. Today's video is also about the similar topic. We are going to understand how we can make better investment decisions that will give you stable flow of income, that is by investing in stocks that offers good dividends. So let's begin our learning journey. The Little Book of Big Dividends is a book written by Charles B. Carlson, an investment expert and author. The book aims to provide readers with an understanding of the importance of dividends in their investment portfolios. In the book, Carlson argues that dividends are a crucial component of successful long-term investing, and that investors should focus on finding companies with strong dividend yields and a history of consistent dividend payments. He provides examples of companies that have a strong track record of paying dividends and offers guidance on how to evaluate dividend-paying stocks. Carlson also discusses the benefits of reinvesting dividends, which can lead to significant long-term returns. He offers advice on how to build a diversified portfolio of dividend-paying stocks, as well as strategies for managing risk. The Little Book of Big Dividends is a concise and accessible guide for investors looking to incorporate dividend-paying stocks into their portfolios. It provides practical advice and real-world examples to help readers make informed investment decisions. Let's dive deep into the principles given in this book that will help you understand the game of investing in stocks with better dividends. Principle 1. Dividends are a key component of long-term investment success. The concept of dividends is an important one in the world of investing, and it refers to the portion of a company's profits that is distributed to its shareholders. Dividends can take the form of cash payments, additional shares of stock, or other forms of value. In The Little Book of Big Dividends, author Charles Carlson argues that dividends are a key component of long-term investment success. He believes that investors should prioritize investing in companies with strong dividend yields and a history of consistent dividend payments. One reason why dividends are important, according to Carlson, is that they provide a steady stream of income for investors. This can be especially valuable for retirees or other investors who are looking for a reliable source of income. In addition, Carlson believes that companies with strong dividend yields are often more stable and less risky than companies that don't pay dividends. This is because companies that pay dividends are typically profitable and have a solid financial foundation. Furthermore, Carlson argues that companies that consistently pay dividends are often more likely to have a long-term focus and a commitment to creating value for their shareholders. By prioritizing these types of companies, investors can position themselves to benefit from long-term growth and stability. Carlson's argument is that dividends are a crucial factor in building wealth over the long term. By investing in companies with strong dividend yields and a history of consistent dividend payments, investors can benefit from a steady stream of income, reduced risk, and the potential for long-term growth and stability. Principle 2. Dividends provide a measure of stability in volatile markets. Author argues that dividends provide a measure of stability in volatile markets. This is because companies that pay dividends tend to be more stable and less volatile than those that do not. There are a few reasons why this is the case. First, companies that pay dividends are typically profitable and have a solid financial foundation. This means that they are less likely to experience the types of financial shocks that can cause other companies to struggle or fail. Second, companies that pay dividends often have a long-term focus and a commitment to creating value for their shareholders. This can lead to more conservative business practices and a more measured approach to growth and expansion. Third, companies that pay dividends tend to be in mature industries that are less susceptible to rapid changes or disruptions. This means that they are less likely to experience the types of volatility that can affect companies in more dynamic or rapidly evolving industries. By investing in dividend-paying stocks, investors can benefit from steady income streams even in turbulent markets. This can provide a measure of stability and predictability to their investment portfolios, which can help to mitigate the risks associated with market volatility. Furthermore, companies that pay dividends often have a track record of consistent dividend payments over many years. This can provide investors with confidence and reassurance that their investments will continue to generate income even in difficult market conditions. Carlson's argument is that by prioritizing investments in dividend-paying stocks, investors can benefit from greater stability, reduced volatility, and steady income streams even in turbulent markets. Principle 3. Reinvesting dividends can lead to significant long-term returns. In The Little Book of Big Dividends, author Charles Carlson argues that reinvesting dividends can lead to significant long-term returns for investors. This is because reinvesting dividends allows investors to benefit from the power of compounding. Compounding is a powerful force that can significantly increase the value of an investment over time. The basic idea of compounding is that as an investment generates returns, those returns are reinvested, and then generate additional returns themselves. Over time, this process can snowball, leading to significant growth in the value of the investment. When it comes to dividends, reinvesting them can amplify the power of compounding. Instead of receiving cash payments from a company's dividends, investors can choose to reinvest those dividends by purchasing additional shares of the company's stock. By doing this, investors can increase the size of their investment in the company, which can lead to larger dividend payments in the future. And as those dividend payments are reinvested, the process of compounding can begin to work its magic. Over time, the power of compounding can lead to substantial returns for investors. In fact, Carlson notes that over the long term, dividends and the compounding effect they provide can account for a significant portion of the total return generated by an investment. Of course, it's worth noting that reinvesting dividends does involve some risks. The value of a company's stock can fluctuate over time, and there is no guarantee that it will continue to pay dividends or that those dividends will increase over time. However, for investors who are looking for long-term growth and are willing to tolerate some risk, reinvesting dividends can be an effective strategy for generating significant returns over time. Principle 4. Diversification is key to managing risk. Diversification is key to managing risk is a commonly accepted principle in the world of investing. Essentially, this means that spreading your investments across different asset classes, industries, or even countries can help to mitigate risk and protect your portfolio against market volatility. In the context of dividend investing, diversification means building a portfolio of stocks that pay dividends from a variety of different industries and sectors. This can help to protect against the risks associated with any one particular sector, such as a sudden downturn in the energy industry or a slump in consumer spending. As the author of The Little Book of Big Dividends, Charles Carlson advises investors to build a diversified portfolio of dividend-paying stocks in order to manage risk and ensure long-term success. Dividend-paying stocks can offer a number of advantages to investors, including a steady source of income, potential for capital appreciation, and a cushion against market downturns. By diversifying your dividend portfolio across a range of industries and sectors, you can help to reduce the impact of any one particular company or sector on your overall investment returns. This can be especially important during times of economic uncertainty, when certain sectors may experience more volatility than others. It's worth noting, however, that diversification alone cannot guarantee investment success or protect against all forms of risk. It's still important to conduct thorough research and analysis before making any investment decisions, and to regularly monitor your portfolio to ensure that it remains aligned with your investment goals and risk tolerance. Principle 5. Focus on companies with a strong track record of dividend payments. This means investing in companies that have a history of consistent dividend payments, which is a sign of financial stability and long-term success. Dividend payments are one way in which companies distribute their profits to shareholders. When a company pays a dividend, it is essentially returning a portion of its profits to investors. Companies that are able to consistently pay dividends over time demonstrate that they have a stable and profitable business model, which can be a positive sign for investors. There are several reasons why investing in companies with a history of consistent dividend payments can be a good strategy. First, companies that pay dividends tend to be more mature and established, with a proven track record of financial success. These companies are often less volatile than younger, high-growth companies that reinvest all of their profits back into the business. Second, dividend payments provide a steady source of income for investors, which can be especially valuable for those who are retired or looking for a reliable source of passive income. Dividend payments can also help to offset the effects of inflation over time, as they tend to increase along with the cost of living. Finally, investing in companies with a history of consistent dividend payments can help to mitigate some of the risks associated with investing in the stock market. By focusing on companies with a strong track record of financial stability and success, investors can reduce the likelihood of losses due to market volatility or economic downturns. Of course, it's important to conduct thorough research and analysis before investing in any individual company, regardless of its dividend history. Factors such as the company's financial health, competitive landscape, and growth potential should all be considered before making any investment decisions. However, investing in companies with a history of consistent dividend payments can be a useful strategy for investors looking to build a diversified portfolio that is focused on long-term success. Principle 6. Beware of high dividend yields that may not be sustainable. While high dividend yields can be attractive to investors seeking income, Carlson advises that investors should not solely focus on yield when selecting dividend-paying stocks. The dividend yield of a stock is calculated by dividing the annual dividend payment by the current share price. For example, if a stock pays an annual dividend of $2 per share and is currently trading at $40 per share, its dividend yield would be 5%. A high dividend yield can be an attractive feature for investors, as it can provide a steady source of income and potentially higher returns. However, Carlson notes that a high dividend yield may not always be sustainable. Companies that pay out too much of their earnings in dividends may not be able to maintain these payouts over the long term. If a company's earnings decline or its cash reserves are depleted, it may be forced to reduce or even suspend its dividend payments. In addition, companies that prioritize high dividend payouts over other areas of investment, such as research and development or capital expenditures, may be limiting their ability to grow and compete over the long term. A company that is unable to reinvest in its business or make necessary investments may struggle to maintain its competitive position and generate sustainable earnings growth. Therefore, Carlson advises investors to look beyond just the dividend yield when selecting dividend-paying stocks. Instead, investors should also consider factors such as the company's financial health, earnings growth potential, and cash flow generation. A company with a strong financial position and a track record of sustainable dividend payments may be a better long-term investment than a company with a high but unsustainable dividend yield. Overall, while high dividend yields can be attractive to investors seeking income, Carlson warns that investors should be cautious and conduct thorough research before investing in high-yield stocks. Investors should focus on companies with sustainable dividends and strong financial fundamentals, rather than just chasing yield. Principle 7. Pay attention to a company's payout ratio. In his book, The Little Book of Big Dividends, Charles Carlson advises investors to pay attention to a company's payout ratio when selecting dividend-paying stocks. The payout ratio is the percentage of a company's earnings that are paid out as dividends to shareholders. A company's payout ratio is calculated by dividing its annual dividend payments by its earnings per share. For example, if a company pays an annual dividend of $1 per share and has earnings per share of $2, its payout ratio would be 50%. A high payout ratio may indicate that a company is paying out a large portion of its earnings in dividends, which could limit its ability to invest in growth or maintain financial stability. The payout ratio is a financial metric that represents the percentage of a company's earnings that are distributed as dividends to shareholders. It's calculated by dividing the total dividends paid out by the company by its net income. For example, if a company earns $1 million in net income and pays out $500,000 in dividends, its payout ratio would be 50%. Investors are advised to pay attention to a company's payout ratio when evaluating its dividend sustainability. A company with a high payout ratio, meaning it pays out a large portion of its earnings as dividends, may not be able to sustain its dividend payments in the long term. This is because the company may need to retain more earnings to reinvest in the business for growth, pay off debt, or fund other capital expenditures. On the other hand, a company with a low payout ratio may have more room to increase its dividend payments in the future. This is because it retains a larger portion of its earnings, which can be reinvested in the business for future growth or returned to shareholders through share buybacks or dividend increases. As a rule of thumb, the author suggests that investors should look for companies with a sustainable payout ratio, ideally around 50% or less. However, it's important to note that a company's payout ratio can vary depending on its industry, business model, and growth prospects. Therefore, it's important to consider other factors such as the company's financial health, competitive position, and dividend history when evaluating its dividend sustainability. Overall, the book provides a clear and accessible guide to investing in dividend-paying stocks. By following these principles, investors can build a diversified portfolio of high-quality companies that provide steady income streams and the potential for long-term growth. That's it for today's video. We'll see you back with another knowledgeable video. Till then, subscribe to our channel and keep growing.